Hi guys, good afternoon and welcome to CNBC-TV18's Mumbai newsroom. I'm Pavitra, you're tuned into Mutual Fund Corner, and today we're going to talk all about debt funds. There are many questions that we've been getting specifically with regards to what we've seen with the Silicon Valley Bank collapse. So lots of questions being raised on the interest rate risk. So to help us understand how you should approach debt funds at a time like this, what your strategy should look like with interest rates rising, and also, what the interest rate risk really is that everybody is talking about. We have with us Joydeep Sen. He's a corporate trainer and author, and he's an expert in this space. So, Joydeep, thank you very much for taking out the time to take us through all of these questions that we have on debt investments and, really building a debt portfolio. So my first question to you, let's start with, what we've been talking about, the interest rate risk, is that we always talk about how it is a good idea to have some kind of exposure to debt, right? But a key risk associated with this category of investments is the interest rate risk. And a lot of people are not too familiar with this. So can you explain this in the context of what we witnessed specifically with SVB?
Sure. Thanks, Pavitra, and greetings to all viewers. Just to put in context, in a portfolio construct, allocation is always important and always relevant. Allocation to equity, debt, or any other asset class like, say, gold. And market levels and market events should not impact that because these are noise. Now, coming to your question of interest rate risk, let's see how it works in the context of a debt mutual fund. Mutual funds publish NAV every day, and of course, those are as per the currently prevailing yield levels or bond price levels in the market, because people come in and exit every day, and that has to be at market-related prices. Now, when in the market interest rates are moving up, that is, bond prices are coming down, the NAV takes the hit, and vice versa. In favorable periods, interest rates come down, prices move up, and the NAV is impacted favorably. Now, why do interest rates move is a long chapter. To put it briefly, it is mostly about RBI rate action, RBI rate hike, RBI rate cuts, or market events that are a precursor to RBI rate action in future. That is broadly how interest rates work. And as you're aware, currently the RBI is hiking rates. The rate has been hiked from 4% earlier to 6.5% as of now. Now coming to the SVB issue, what has actually happened is, because of the systemic issues, there are question marks about the room going forward to the US Fed to hike the US Fed rate. So sometime earlier, there's something called the US Fed terminal rate expectation. Sometime earlier, the market was saying it will be like 4.5% at the end of the rate hike cycle. Then the market said 5.5, 5.75 at the end of the rate hike cycle. Now the market is saying something much lower because now the scope to the US Fed is that much more limited because of the banking system issues. So consequently, what has happened is US Treasury yields have come down significantly. US Treasury 2-year yields, 10-year yields, they have come down really significantly. So the impact has been positive, and on positive sentimental impacts, our bond yields also have come down to an extent. Our 1-year, 2-year, 10-year reset bond yield levels have come down to an extent. So net-net, the impact of SVB has been yield positive, which is quite contrary to the events in the equity market. So in a way, equity and bond markets work a little differently. It's a different issue that bond yields of Credit Suisse have moved. That's a different credit issue altogether. I would say Swiss credit, or what I would call it. But SVB per se has been positive for the yield or interest level scenario in the market.
All right, Joydeep, that really explains it. And I'm glad that, our viewers will be able to understand what this risk is that we talk about so often when we talk about debt funds. But, in a situation when interest rates are going up, we've been in that space for a while, the, value of previously issued bonds starts declining. What do you do as a debt investor? Do you just hold to maturity? Because, several times, if you just hold it for the stipulated period, it can also just average out, right?
Exactly. You do exactly what you said, hold to maturity. Now, let me explain what it is. Take an example, a simple bond. Let us say there is a 3-year maturity bond. You buy the bond today. Now, if you buy the bond today and sell after 1 year, how much is your return? Your return, if you sell after 1 year, depends on the market level at that point of time. But if you hold the bond for 3 years, you get the initially contracted return. Market level does not matter. Now, coming to debt mutual fund schemes, it is not exactly averaging out. How it works is, let us say you enter into a mutual fund. Now, in a debt mutual fund, in the usual funds, not the FMP or target maturity fund kind of categories, in a usual debt fund, there is no maturity per se, but there is a portfolio maturity, which is the average of all instruments in the portfolio. If you enter a debt fund of, say, a 3-year portfolio maturity, and you hold the fund for 3 years, you will get decent returns. How or why? over an adequate holding period, two things happen. One is you get the coupon, which is the accrual over those 3-year period. Plus, over an adequate period, market cycles, up, down, these things happen and these things settle down. So at the end of an adequate holding period, you get decent returns. So basically, if it is an individual bond, you hold till maturity. If it is a FMP or target maturity fund, you hold till maturity. And if it is a usual open-ended debt fund, then you hold for an adequate period of time as an indication as per the portfolio maturity of the fund, and then you will get a decent return. So it is as simple as that.
All right, got that. So the answer is never to, simply panic in this situation and just try to get out, because that is what a lot of people have been doing, right? And a lot of young investors specifically ask us this, and they just don't know how to behave in this kind of situation when rates are going up. So that's helpful. But, Joydeep, since in general bond funds tend to do well when interest rates decline because, securities already held in the fund's portfolio likely carry higher rates, then of course the new bonds. Do you think that if there's a new investor, say they're just getting into the market and looking for debt funds, do you think it's best to wait for a while on debt, or do you think you're never going to be able to time it?
Just one point on your previous thing, not to panic. One distinction between equity and bond is that in equity there is no maturity. These are perpetual instruments, whereas bonds are defined maturity instruments. Similarly, bond funds also have a defined maturity, and that way you are more safe in the sense volatility is that much limited. And volatility can be handled. That is one basic difference. Now, coming to your query about new investors. So now, new investors can be of various categories. Like there are millennials who have started earning now. There could be investors investing in equity, wanting to park in debt for some time. Or it could be someone used to a bank FD kind of variety who want to come in now. Now, coming on to the topic of waiting or investing, one basic concept of investing is don't time the market. Like in equity, the same. Don't time the market because nobody knows the peak, nobody knows the bottom. You just come in with an adequate time horizon. And that is how it works in bond funds as well. Don't time the market. But having said that, as of today, we stand on a better platform. And what is that better platform? Today, we are near the end of the rate hike cycle. So like I said earlier, RBI repo rate was 4% earlier. It is 6.5% now. Now, nobody knows the future for sure, but broadly, we are towards the peak of the rate hike cycle, maybe one more rate hike from 6.5 to 6.75. And whatever happens, it is mostly there in the price level in the market. So what it means is, since we are near the peak of the current rate hike cycle, these levels are good, and it is a good time to enter bond funds. So there is no need to wait as such. Having said that, over the next few months, yield levels may inch up a little bit here and there, but that's okay. Don't time the market. You just come in with an adequate horizon and sleep peacefully.
Sometimes the solution is really that simple, right? That if you come in with a slightly longer time horizon, you don't need to worry about these individual moves so much. But Joydeep, since you were saying this is a good time to get in, just get in now. Don't bother with timing the market. Do you want to take us through some categories which you believe are good spaces to be in now within the debt space?
Okay. Just to give a flavor of the current times of the debt market or bond market, currently the yield curve is very flat. What it means is the yield you get on a 1-year instrument, 1-year bond, a 3-year bond, or a 10-year bond is same or similar. What that in turn means is, you don't get that yield uptick, that kicker for buying a longer maturity bond. So now it is ideal that your horizon is so much. Your cash flow horizon is 1 month, 3 months, 3 years, 5 years, 10 years. You have a defined cash flow horizon. You match your investment horizon with the maturity of the fund. Now, what is the maturity of a fund? If it is a usual open-ended debt fund, there's a portfolio maturity. And if it is a target maturity fund, there's a defined maturity as such. On the date, the entire fund matures and the money flows back to the investor. So ideally, you match your horizon with the maturity of the fund. That is point number one. Next point is, in the market, what some people are doing now is, people are taking a duration call. Now, what is the meaning of this duration call? Duration call means taking exposure to a long maturity bond fund with a less than adequate horizon. That is done on the expectation that going forward, RBI will cut rates, interest rate will ease, and will get the benefit in the NAV, because when interest rates come down, bond prices move up, and you'll get the benefit in the NAV. So with that expectation, some people are taking a call on long maturity bond funds, which is called duration call. And there is no issue as such on that, because as I said, we are near the peak of the rate hike cycle. But again, I'm not very enthused about the idea. And the reason for that is when we say rate cuts going forward, let's say 1 year down the line, the visibility as of now is not very good. What is the situation as of now? As of today, the RBI says the inflation projection for going ahead, Jan-March 24 is 5.6%. Within 6%, but still not really very good for a rate cut going forward. There talks about El Nino current and all those things, which means less rainfall and impact on crop and inflation and all those things. So given that the visibility on the next rate cut cycle is not as good as of now, I'm not very enthused. I would rather wait for some more visibility for taking a duration call. As of now, ideally, so there are so many debt funds. There are 16 debt fund categories, plus there are FMPs and target maturity funds of various maturities. You decide your horizon and invest according to the maturity of the fund.
All right, got that. And since you're, mentioning that there are so many categories, I'm going to ask you specifically about, funds that invest mostly in short-term assets, more secure. Do you think this is a good bet at a time like this, or it's only a factor of what, what you are looking at, what your duration is in the market?
Okay, so to put in perspective, since you said short-term and less volatile, there is this concept of modified duration. So modified duration is a metric which we call the sensitivity or the multiplier. What it measures is when there is a movement in the market in terms of interest rate, what is the consequent impact of that on the price of the bond or the NAV of the debt mutual fund. So that is why we call it the multiplier. So market movement so much, and how many times, like 1 times, 5 times, 10 times, that is the multiplier impact on the price or NAV of the debt fund. So obviously, shorter the maturity of the fund, shorter is the modified duration, shorter is the volatility. So that's how shorter term maturity, shorter term funds are more safer in the sense they are less volatile in that sense. And it always works. So you would be a new investor, you may be a seasoned investor. Now, when your horizon is like, say, 1 month, 3 months, 6 months, you come into, let's say, a liquid fund or ultra short term fund or a low duration fund according to your maturity horizon. If you're a new investor, yes, you may feel more safe in a shorter maturity fund. But even if you're a seasoned investor, for a short horizon, don't go for long maturity funds. However, on the other hand, if you have an adequately long horizon, like say 3 years, 4 years, 5 years, you don't have to be as conservative as to invest in a liquid fund or ultra short duration fund. You can match your horizon with the portfolio maturity of the fund. And last point on this question, when you say secure, there is one interest rate risk and there is one credit risk or a credit safety aspect. Now, there are government securities of up to 40-year maturity. So duration is long, but there is no credit risk. There's the interest rate risk there. So two aspects are separate.
All right, that really explains it. And, like you said, depending on your time horizon, you can take a call. And Joydeep has mentioned what would perhaps suit you better at that time. We do need to take a short break now. But Joydeep, you mentioned a whole bunch of other categories such as the target maturity funds, credit funds. So I have lots more questions. Get into a short break. We'll be right back to continue this conversation. Hey guys, welcome back. You're still tuned into Mutual Fund Corner here on CNBC-TV18, and we're having a conversation on debt funds with Joydeep Sen. Joydeep, the next question, because you mentioned this as well during your chat earlier, is target maturity funds. Do you think this is a good bet to get into right now?
Definitely. And this is my favorite fund category.
Yeah.
So let me explain. In bond investments or debt fund investments, there are basically two kinds of risks. I mean, other risks are there, but you can ignore those. One is interest rate, one is the credit risk. And in a way, target maturity funds take care of both the risks. How? So one is when you buy a bond and hold till maturity. On maturity, the market level does not matter. So their target maturity funds are various maturities, 3 years, 5 years, 10 years, 14 years, 15 years. So when you buy a target maturity fund and you hold till maturity, you are effectively doing away with market risk. That is taken care of. And coming to credit risk, usually the portfolio construct of PMFs are like government securities, SDL, that is state government securities, and AAA rated PSU bonds, which means with a very good quality credit portfolio, you can more or less say there is kind of no credit risk. So both this having been taken care of, this is a very good fund category. And to add to that, like I said earlier, we are near the peak of the interest rate cycle. So rates are kind of good to enter. So that way, it is in a way very good time to enter into target maturity fund of an appropriate maturity. As in, if your horizon is 3 years, come to a 3-year fund. If your horizon is 5 years, come to a 5-year fund, and so on and so forth.
All right. You said this is your favorite category of debt funds. Seems like it's a lot of people's favorite categories, right? Because it's just picking up in popularity more and more. But just one final question, I have to squeeze this in, is how do you look at debt funds right now? And what are the things to consider when you invest in a credit debt fund?
Okay, so firstly, what is a credit risk fund? As per SEBI definition, 65% or more of the portfolio has to be invested in bonds or other instruments rated AA and below. So there is an element of credit risk in the sense that much component is not there in, say, AAA or AA plus rated securities. Now, coming to a question on the risk or how is the timing now, I'll give it two perspectives. One is fundamental and one is practical. Fundamentally, things are much better now. Now, what is the meaning of much better now? If you look at the previous default cycles happened from September 18 ILFS to February, March 2020, that is Yes Bank 81. That default cycle is over. Now corporate health is much better. If you look at the credit ratio of rating agencies, ratio means ratio of upgrade downgrades. The credit ratio of agencies like CRISIL, ICRA, CARE, it is much better than earlier. It is very positive now, which means corporates are doing well. And as you're aware, in the COVID phase, corporates did a very good job of deleveraging. So balance sheets are much better now. Both bank balance sheets and corporate balance sheets are much better now. That part is taken care of. The other aspect is the practical aspect. And what is that? You look at the portfolio YTM and you look at the net of expenses and the net of expenses YTM. Compare credit risk funds with better quality like corporate bond or banking PSU fund. If the differential is palpable, then it makes sense. Like if it is a 1% differential, it makes sense. If it is like 10, 20, 30 basis differential, it doesn't make sense. So look at that. And just to clarify here, as per SEBI regulation, a mutual fund cannot guarantee or cannot indicate any returns. So not to indicate something, but just to say that YTM and expenses are publicly available data, you can just access that data and use that data to take your decision and measure the practical differential between a credit risk fund that of good quality like corporate bond or banking PSU funds.
All right, that really simplifies it. Joydeep, it's been a pleasure having you on this show. Thank you very much for joining us and really taking us through all of these different categories, as well as, what would be a good fit for what kind of investor. We're going to leave it on that note today. And with that, we're going to wind down on this show. But you stay tuned because closing bell is up next after this short break to take you through the final hour of trade.